Hi, Andrew Bell here, coming to you from a pretty nippy Gold Coast, having its first taste of winter cooler months. A flood of economic news has surfaced, all of which has an effect on the real estate market. So I'll quickly cover each of those topics. First up is the latest report on our economy, which showed in the March quarter that the previously thought weak economy was in fact much stronger than expected, with exports and housing markets driving a surprise surge in economic growth. Growth for the 3 months to March rose 0.9%, outstripping the economists' broad estimates of just 0.5 to 0.7. That meant for the year to March, the GDP was actually 2.3%, well above the forecast 1.9%. The main drivers were that net export adding 0.5% to growth, with household building and government spending also considerably stronger. It comes as no surprise it boosted the Australian dollar, which shot up half a US cent. The Australian dollar has really frustrated the Reserve Bank, remaining stubbornly high. It's usual for the dollar to fall when interest rates are lowered, but there was a surprising rise in the dollar following the latest interest rate fall early last month. And of course, it also rose off the back of this strong economic results. There is no surprise with low interest rates and better economic news that consumer confidence has also risen. This is the strongest response to a federal budget since 2006 and 7. With this latest economic news, we can expect even further strengthening in consumer confidence, and that should flow through to consumer spending. Great for the economy. The jury is out now on the next move in interest rates. There's been strong arguments for yet further drops in interest rates, but with the strong Australian dollar and the likelihood of it even perhaps strengthening, we're likely to keep interest rates as they are for the foreseeable future, as they did happen in June. Another reason interest rates are unlikely to fall further at this stage was the increase in job advertisements, which bounced back 2.3% in April, after falling for the first time in 10 months back in March. The increase in job ads suggests that firms are now back into hiring, so this should follow through to a drop in unemployment. The latest inflation figures is also going to contribute to the mix of factors that the Reserve Bank is watching when they make a decision on interest rates. They have a desire to keep inflation between 2 and 3%, and usually there's an increase in interest rates if they see inflation rise above 3%, and there's a tendency to drop interest rates if it falls below 2%. Well, the current inflation for the March quarter came in at just 1.3%. I can't remember an inflation figure this low in a mighty long time. So this is also another reason why we shouldn't be expecting significant price growth in real estate. If property values rose 5 or 6% in a year, that's 3 times inflation, and would certainly be, for property owners, the very best investment you could be making in the marketplace at present. The March quarter also showed that home resales generated $17.1 billion in profit, with the average resale making just over $251,000 in profit. No wonder real estate is such an attractive option. The report also showed that just 8.6% of sales reflected losses, which is the lowest number since the June quarter of 2011. Now, this would be reflecting people who bought at the peak of the market and who sold somewhat premature. This is a reminder, however, that it's important to watch the cycles. Buy at the bottom of the market and sell at the top. Seasonally adjusted new home sales in March were 4.4% higher than February, and is the highest level since early 2010. Now, a really significant trend at the moment is the multi-unit sales, which rose 11.3%, whilst housing sales were just up 2.6%. This significant increase in apartment sales reflect the increase in investor demand and the buying activity, but this also shows a desire for inner city living, which is largely provided through apartment living. This trend is expected to continue, particularly because of the trend for apartment construction being much bigger than housing. Another report just out shows negative gearing investors now total 1,967,260 across Australia, according to the ATO. There was an increase of 156,000 negative gearing investors between the financial years ending 2011 and then 2013. This of course reflects the increase in the number of investors into the market, providing housing for our significantly growing population. But also, interesting to note that low interest rates have allowed a significant number of Australian landlords to cut back their tax deductions through lower interest rates. And many more are now creating cash flow positive situations. This certainly means that an increasing number of landlords are in a position to buy yet another investment property, adding and using the equity in their existing investments. Last but definitely not least, the first quarter of 2015 saw rental rates on the national basis rise 1.35% for the quarter. Of course, it varies significantly throughout the regions, but the Gold Coast is one of the strongest markets because of the strong demand for rental accommodation due to rising populations here on the coast and a significant shortage of investment properties. This is a great opportunity for investors from around Australia to capitalise on. So as you can see, there's a lot happening and there's a constant change. But there is, I guess as a general comment, a really positive improvement right across a wide range of areas. And that certainly will flow through to the real estate market. The next e-News, in a fortnight's time, we'll take a closer look at the supply and demand equation. So until then, health and happiness to all.